Hey, good evening, everyone. Marty Mazzora here, 28th of October, 2022, coming at you one more time this evening, although you probably won't get this till tomorrow morning, but this is your weekly economic update. I'll try to keep this one relatively brief. I kept you quite a while on the market snapshot earlier today. I did mention in that video that I thought our index would drop some. It didn't drop by much, went from a -7 to a -9, which to us denotes odds favoring recession going forward, as opposed to continued expansion. And as usual, dialed up a handful of the inputs to our index. There's 45 in total. This week we'll start with some consumption data. The PCE, or personal consumption and expenditures data, was released today for September. And with regard to consumer spending or consumption, you can see we rose by about 0.65% on a month-over-month basis, which was slightly above expectations. Personal income was up 35 basis points or 36 basis points month over month. 5.2% year over year, which was also slightly above expectations. So those two would score a positive. The savings rate, however, continues to drop down to 3.1%. And that, of course, would suggest that consumers obviously are saving less. We do know that they're continuing to spend. You just saw it in personal consumption expenditures. And we know that certainly from the service sector data, that while consumers don't seem to be spending as much as they were, of course, around COVID and immediately following on merchandise, they do seem to be spending on experiences. With mortgage rates average this week 7.16% for a 30-year mortgage, it's no wonder that mortgage purchase applications have been falling off a cliff. Consumer confidence, we got both the conference boards this week as well as the University of Michigan's. The Conference Board Index fell to 102.5. It was 107.8 previously. The estimate was at 105.9, so it came in below expectations. Most of the decline showed up in present situations, but expectations were off as well. One-year inflation expectations rose 0.2% to 7%, and they were down slightly in September. So the Fed pays attention to inflation expectations, so that would be negative in terms of what we know the market would like to see the Fed do at this point. The University of Michigan's, however, actually rose. Of course, two different sets of questions, far fewer questions in the University of Michigan's versus the conference boards. So it was higher than expectations, just barely, 1/10 of a point. One-year inflation expectations in this survey were 5% versus 4.7% the previous month. Durable goods orders were released this week. Core durable goods down notably month over month and down notably from expectations as well. Caterpillar Global Sales comes out quarterly when Caterpillar announces their earnings. This is a good look, beginning to tick back up here, up 2% worldwide, pick up in Asia, pick up again in North America. And again, these were all negative, right? So we're seeing this. We do know that there's going to be quite a bit of infrastructure spending coming over the next year or two. So perhaps there's some sales getting in front of that a bit. Latin America for the second quarter in a row, although off from the previous quarter, up 9%, although still trailing down 2% again in Europe, Africa, and the Middle East. And the employment cost index off a little bit from the all-time record, off a little bit on a quarter-over-quarter basis. That's at 1.2%. In terms of wages and salaries, they were 1.2% quarterly, 5.2% year over year. Higher employment costs, of course, comports with what we've been talking about herein for quite some time now. And I emphasized in the video earlier today that we're entering this labor-friendly regime, which is quite inflationary. And to emphasize that, this year-over-year figure in wages and salaries literally is double the 20-year average. And then last but not least, the consumer staples, consumer discretionary ratio, which is this one. This is rising. Consumer staple stocks, defensive, economically defensive, let's say, stocks are performing better than consumer discretionary stocks. And you can see that vividly here when we break it out. Consumer staples ETF, the consumer discretionary ETF here. So folks, that's it for the economic update. We're continuing to stay below the zero line in our index, which means, again, odds favoring a recession going forward. That's our base case. We do expect earnings, corporate earnings, to adjust a bit more to the downside for that reality. You may recall, those of you who watched the earlier video, that I did say that our index would probably tail off a little bit, and that negative data this week was probably good for the stock market. And that's because you could argue that the bear market to this point has been mostly multiple contraction or valuation contraction relative to interest rates going up, right? Interest rates rising would call for lower valuations in stocks, all things being equal. The next leg being corporate earnings adjusting downward based on the reality of recession. Now, of course, that happens. But we do have a unique situation here because we have the Fed has pushed interest rates to levels that we haven't seen in quite some time at a pace that we haven't seen in 40 years. And that has really played havoc with stocks. So we've got kind of this combination. As the recession hits, if indeed it does, and corporate earnings come down, we should see yields come down with that. So that will be an offset to the negativity that the corporate earnings would bring to stock prices. So we keep pointing to that 3,500 price target, but when we set that originally, our assessment was no recession. Now our assessment is yes, recession, albeit a mild one. So based on that, we have to say that it's likely that we penetrate that 3,500 bottom. We do not have to. There's no law that says we will. Perhaps what I just explained about the relationship between interest rates coming down and stock prices versus earnings contraction as well, that perhaps to the extent that we do, it won't be something quite as dramatic as your, say, 2008 bear market or the tech bubble, early 2000s. Nevertheless, we do think that there is a lot of leverage underneath this market, particularly in the credit markets, that could crack or could break, and you could get the kind of waterfall reflexive sell-off that would be, greater than average in terms of bear market declines. So we still want to hedge with the put options under this setup, if you will. At some point, we will have great conviction about the market having bottomed, new bull market, and so forth. I talked earlier about what that timeline may be and our thoughts about 2023. But for the time being, we want to continue to hedge against something, for lack of a better term, cataclysmic to the downside. But we are beginning to rotate our portfolio and take advantage of some values that we think are really emerging. I mentioned Amazon earlier today. So folks, I will leave it there. Thank you, as always, for watching and listening. Probably won't hear from me again until the Monday morning note. Hope you all have a wonderful weekend. Take care. Bye-bye.